Hi, welcome back to another edition of Lippers Fund Flows Insight. My name is Tom Rothine. Thank you for joining me today. I'm going to be talking about fund flows, weekly fund flows for the weekend Wednesday, February 12th, 2014. This week we actually saw pretty good inflows. In fact, the fourth consecutive week that we've seen inflows into the group. About $11.4 billion came into the conventional fund business. That's ex-ETFs. We'll talk a little bit more about ETFs, but certainly it was a good week. And that's a couple of things came out. First of all, we saw Janet Yellen give us a little confidence boost, saying that basically the interest rate stuff that we've been working on as a Fed as a whole is going to stay basically the same now that she's under command. And I think that was a sigh of relief for a lot of investors. Secondly, we heard about good growth indication out of the Bank of England. So when we take a look at Bank of England and their numbers, actually they had economic growth numbers that were good. And this week we also had good news that China actually had some growth on the plate as well. And I think that was a sigh of relief. We saw some emerging markets actually doing better and the like. And in fact, returns for the week, S&P 500 was up 3.97% for the weekend, and again Wednesday, February 12th. So let's take a look at the macro groups to see where flows were because of this grand news that we saw. Equity funds saw about $3.3 billion in net new money come into their coffers. Taxable bond funds took in about $2.6 billion. Muni bond funds saw a little bit over $60 million. We'll call it 0.1 on our sheet here. And then when we take a look, again, one of the big players, but not as big as it's been money market funds, taking about $5.5 billion. So certainly that wasn't like we've seen in other weeks where investors were putting money back to work in the fund industry, but really kind of ducking for cover by putting it in money markets. They really spread it around to all groups. It's only in the last couple of weeks that we've seen all four macro groups taking in money like we did in this time. Well, let's see how it broke out for equity funds and what happened in the equity universe. Equity funds, again, saw about $3.3 billion in net new money come in their coffers. 8 consecutive weeks that they've seen money come into their group. A 3.86% return, and this is the first week in 3 that we've seen positive returns. As we break this out, domestic equity funds, basically when we're taking a look at the domestic group, domestic equity funds took about $1.6 billion. Really it was close to 1.7, but the rounding issue was there. Then we took a look at non-domestic equity funds, about 1.7. So really it was kind of a push. About 1.7 for both groups taking money in. As we saw though in the past, the non-domestic equity funds have been taking in money for about 9 consecutive weeks, or non-domestic equity funds just for the 4th week in 5. So certainly people have been playing more towards the non-domestic equity. And in fact, when we take a look at it, we saw large cap funds taking about $1.4 billion. And then when we took a look at the international side to see where it was, we saw that the international equity fund group took in about $0.8 billion. And of that, we couldn't really attribute any to the emerging market group. We saw about $0.3 billion, or about $300 million in outflows for the week. So certainly it's been a little bit of change. People are still preferring to go into the, if you will, the developed market type of funds, so European region funds and the like saw money in there. Let's see what happened on our ETF side of the business. For the first week in 6, we saw inflows $3.5 billion. People have been really pulling money out of equity funds on the ETF side, and I think they just saw a lot of volatility they were very unsure about. And again, Yellen and seeing some good growth out of China certainly helped out a lot. Where the money was, SPY, Spider S&P 500, saw about $3.6 billion net new money coming to their group. Then we saw Materials Select Sector Spider Fund taking about $500 million. And then when we look at the bottom of the pile, iShares Russell 2000 lost about 0.9, about $900 million. And then we saw iShares US Industrials lose about $600 million as well. So this was kind of the story as we were taking a look at it. There was some good flows, but really the behemoth SPY took in the majority of that. Well, let's see how these flows actually translated into our fixed income group, because that's certainly a story that we've been talking about for a while. For the 6th consecutive week, we've seen flows into bond funds, about $2.6 billion. It's the first week in 3 that we've actually seen plus side performance, about a 0.68% return for the week. And where we saw the money flowing was corporate investment grade debt funds, saw about $1.4 billion. We saw flexible portfolio funds taking about $780 million. This is the 6th consecutive week that we've seen that. And if we look at the bottom of the barrel, government treasuries were still having a problem, $131 million in outflows. But really, a lot of money flowing in, and high yield funds was certainly a story. So people were looking for yield again. They were willing to put on more risk again, and they were really ignoring, not necessarily running, but ignoring the treasuries this round. Again, government treasuries just saw a little bit out, $131 million. Let's see how it happened on the ETF side, though. This is one of the big numbers we've seen. $4.1 billion in net new money coming into their coffers. 2nd consecutive week that we've seen ETFs taking money. And really, it's been basically on the short end. And we're going to see that it was 20-year treasuries. Well, I mean, it was just kind of a weird week. People were making just unique bets. iShares, 1 to 3 corporate bond, actually saw about $896 million on the inflows. But if we look at the very bottom, Pro Shares, the ultra short Lehman 20 plus saw an outflow of 98. But then in the middle, as you can look at of the inflows, we can see that there was, along with high yield funds, there was also some longer dated treasuries as well. So people were certainly, and when we look at this, it really is a qualified investor out there that is actually making ETF purchases. Those folks were actually, making bets all over the place, and there was really a good month for inflows for fixed income ETFs. So that was something we wanted to point out. Let's move on to muni bond funds. Now, this has been a story we've been talking about. Again, I told you a little bit earlier they only saw about $63 million in net new money come into their coffers. It's the fourth week in 5, however, that we've seen positive flows. Last week we had a little outflow. People were really concerned it was because of the downgrade by the agencies of Puerto Rican debt, and we're finding that people are just able to go out there and say, hey, listen, we're taking a look at the after-tax returns, and the yields are much stronger than their taxable brethren. They're willing to put up with a little bit of the trouble that's in Puerto Rico debt, and most of their holdings in most of the funds that are doing well are not, don't have any Puerto Rican debt or getting rid of Puerto Rican debt. So certainly that was a good story. This is 7th consecutive week we've seen plus side performance out of that group. 0.04 is not a lot to talk about, but again, it was the 7th consecutive week, so people are certainly seeing a change. It was a baby with the bathwater. People threw out all of the good stuff and the bad stuff together, and now they're going back and buying some of that good stuff back. National munis actually saw about $158 million of net new money come into their coffers. Of course, that means that the single states suffered outflows for the group, considering we only had $63 million net new money into that group. Well, that brings us to our money market funds. And our money market funds for the 2nd consecutive week saw $5.5 billion in net new money come into their coffers. How it broke out, taxable money market funds took in $7.1 billion, while we saw about $1.6 billion come out of tax-exempt money market funds. Looking at the taxable side, though, we see about $5 billion going into institutional money. And then we see, the retail investor going into the normal money market funds putting in about $2.1 billion. So certainly people were still kind of leery about putting their money back to work, but it was certainly evenly distributed throughout the week. Now, in the last 2 days, we've had a little bit of disconcerting news. We saw that the retail sales actually came in below expectations, lost about 0.4% on the sales front in January, and then again today we heard that industrial production declined by 0.3%. That was greater than expected as well. And I think most people are going to be attributing this now to the weather. Certainly that's going to be it. But again, even after we've heard some good news throughout the week, and now we've had this bad news at the end of the week, we'll have to see what investors, how they really interpret it, and how the flows are going to change over the next week. Well, if you want to do a deeper dive, please join us at lipperusfundflows.com, where you can do a dive on any one of the classifications, macro groups, the like that you'd like to do. Or if not, join us next week where one of our analysts will be talking about the flows. Until then, my name is Tom Rosine, wishing you the best in your wealth planning and creation. Thanks for joining me.